Hello there, Prof. Aram here, and in this video I'm going to go over the agency cost theory of capital structure. So let's get to this. Managers, if they have a choice, they prefer not to issue any debt because then they get to keep all the cash inside the firm and do not pay any interest to the bondholders. That way, they can control all the retained earnings of the firm however they want. So they have a lot of free cash flow in hand and they can use it for whatever they want, including to benefit their own self, meaning that they can use that cash, they use the extra cash they have for their non-value maximizing purposes, such as flying private jets, being the members of golf clubs, and so on and so forth. So there is an agency problem here. So one way to minimize that agency problem or agency cost is to introduce debt to the capital structure. With more debt in the capital structure, you're going to increase the fixed cost of business for the firm. That means that the managers have to pay this fixed cost, have to pay this interest expense every month, every quarter, every 6 months. So this lowers the free cash flows available to the managers inside the firm. This lowers the amount of cash available for managers to misuse. In other words, this financial leverage bonds the free cash flows of the company, which forces discipline on managers to avoid perks and non-value adding acquisitions. This is one side of the agency problem. The other side of the agency problem deals with the potential for underinvestment. If the firm is highly levered, if they have too much debt, it may overly constrain managers. Keep in mind, if you're the CEO of a company, the majority of your wealth comes from that one investment, one company. So a large portion of the manager's personal wealth and reputation is tied to single companies. So managers are not as diversified as a rational investor. So because of that, they may not take risky positive NPV projects. You can have positive NPV projects that are risky and they can still add value to the firm. But because they're risky, these managers who are overinvested in one firm choose to forego that. Even though a well-diversified stockholder would find the risk acceptable. So the more debt the firm has, the greater the likelihood of financial distress and the greater the probability of bankruptcy. And because of that, there is a greater likelihood that the managers of this company will forego these risky projects even if they have positive NPVs. Because if any of those projects fail, then they have reputational costs for the managers, and of course they're going to lose a lot of their own personal wealth. I hope you find this video useful, and thanks for watching.